Hello everyone and welcome back to BFW 2401 week 8 part 2. So in this part we will discuss the portfolio risk, credit risk. Specifically we'll talk about the concentration risk. Now I have few models and I don't think we will have any problem understanding those models. They are very straightforward. So if you allow me to share my screen now on my slides, let me go to the slides directly. So we are talking about this part, which is part 2. As you can see now, we are working in this area. As I said before, this is just a map, as you know. So this is, we are talking about this area, which is portfolio risk. Actually, we are about to end the semester, as I said before. And this is mostly in this part, talking about some modeling here. Now, where to find this? It's actually in chapter 11, credit risk 2, loan portfolio and concentration risk. Now, this is actually the blue line, which we are talking about today. It's actually here. So we are talking about this area, which is, we will talk about the migration analysis, concentration limit, regulatory treatment, but we will not actually talk about regulations. I will give you a hint that you are not responsible about this. We'll talk about it later on. And then we will talk about the MPT, which is the modern portfolio theory. Most importantly, in this part, we will talk about the derivatives that we use to manage credit risk. Now, to manage credit risk, we can hedge it through what we call financial derivatives, or we can do, as we talked before, securitization and long sales, where we can get rid of all those loans and give the responsibility of collecting and the credit risk to someone else. Now, let me go through this. So we're talking about, as I told you, immigration analysis. And when we talk about immigration analysis, so immigration analysis, a concentration limit, and then the concentration limit, we will talk about this formula. And then, as I told you, the regulatory treatment, we are not talking about it, and I'm giving you a hint here that regulatory treatment is actually not covered in this week, or in this the materials of week 8. Now let me go to the concentration and migration analysis. Remember, we are talking now about the portfolio you have, and this portfolio, assuming it is a group of loans, a group of bonds. Now, assuming you can say that you may invest in AAA, BBB, or CCC, or any other rating. Now, if this is the first of the year, which is 1 or 2 and 3, you want to see where this investment in the market. Now, we are talking about the market. You are following this from the market. You want to see where the how this companies in AAA rating will change over the year. And how about the class BBB2B? How many companies from here will be upgraded to A, and how many of them will be downgraded to C, and how many of them will default? The same thing applies to AAA. How many will stay in A? How many will go to BBB? How many go to C? How many will default? So in this case, we will take the rating of all those companies, and we will see how many ratings. So in other words, if we are going to invest in any of those companies, whether AAA or B or C, we want to see what is the average or the probability of those companies actually changing their rating, by the end of the year. So as you can see here, we have AAA first of the year, which is 100%. Now, by the end of the year, only 85% stay there, 10% go to BBB, to B, and 3% goes to 4% goes to 3, and only 1% default. If you look at the triple B, they used to be 100%. 12% of them actually was upgraded to A, to 1, and 3% were downgraded to B, to C, and 2% of them were defaulting. Look at the triple C, which is number 3. They used to be 100%. Now they actually upgraded. Now 4% of them defaulted, but 13% of them upgraded to B, and 3%, which is something outstanding here, jumped to 1, which is to A in 1 year. So how can I use this information? This is the question. How I'm going to use this information? Well, the way to use this information, we can look at this. Now, if you have, for example, for loans that begins the year at triple B, as this is just explaining this area, which is this triple B, giving us this example. So for companies that start with triple B, strictly is 12% have been graded to A, 80% stay in the same area, and 3% go to C, and 2% defaulting. Now, suppose that the financial institution, which is your financial institution, is evaluating the credit risk of its current portfolio. And they have companies, they have investment for those companies who are in A and B and C. But you find that for the last year, much higher percentage actually was the drop. For example, you have a triple B, but the companies you have, you find that 5% actually of loans have been downgraded to C, which is actually here, the average is only 3%. Your companies, your investment have dropped 5%. And the one that goes to C and higher percentage has defaulted, which means 3% now defaulted. Here, the defaulting is only 2%, which means you are holding below the average companies. It's okay, it's from the same stage, it's from the same group of ranking, but it looks like the companies that you are investing in is actually have more higher probability of downgrading and for defaulting. So you may consider your portfolio to be changed. So you may restrict, investment in triple B. Maybe you go to C. At least when you go to C, you have 4% here. 13 will grade it to B, and 3% graded to 1. Of course, you will have more return, but now in the same times they will, those will be upgraded. So you may consider that you restrict triple B because the companies you have is actually not really, they are downgraded more than they are riskier than the market. This is what we are saying. So one of the things you may consider restrict lower quality loans and continue with higher quality loans. Maybe you will just maybe you think to go to triple A also. So you just leave the B. C also can be an option, but in this case, A also is another option. You may consider that, but actually you may limit, investing in triple B. Now let me go through. This is very straightforward, which is the concentration limit. Concentration limit C, the losses. The concept is the losses we have. When we have losses, these losses actually is charged to our capital. Now you have so many industries working, and you have to make some type of concentration. How much you pay loans to this industry, how much you pay loans in this industry. It depends on what is the maximum losses you can have from your capital. So actually you have to take the maximum loss from your capital to one industry in one concentration. This is the limit you can have. And you have to look at the industry itself. So in this case, if the management make high tolerance, which means the limit of losing if they lend to this industry if 5% of their equity, because the equity is the one that will take the losses for sure. So if they say, okay, we will accept up to 5%. So if you want to limit yourself to these 5%, and you find an industry that is making a loss of 10%, so if the average historical losses in the financing in this farming sector is 10%, what is the maximum loan manager can lend to a firm in this sector? So, which means if you know this 10% and you have a limitation 5%, how much of your capital you can lend? According to this formula, you can lend 50%. So it's maximum limit, 5% times 1/10. So maximum loans going to this should not exceed 50% of your capital, which means if they lose 10%, that 10% equal 5%, which is actually your limitation. This is the whole thing. So it's 5%. So how much the maximum loss is here? It's 5% of your capital. It's 5% of your capital. This is actually should be very straightforward. Okay, now let me go to this one. As I told you, we are not talking about it. As you can see, this one we are not talking about it. So don't worry about it. You can ignore it for the time being. Now let me go to the modern portfolio theory, which is the fourth model here. Modern portfolio theory is coming actually from investment. The concept behind this is to calculate the list. This is what we call the volunteer. So this we call it the efficient volunteer. This green light is the efficient volunteer. Now, the efficient volunteer means this is one, this, for example, is one what you call portfolio. This is the second portfolio. This is the third portfolio. You have so many portfolios and you have to draw a line around them. And you just go directly and choose the least one. The least standard deviation. So this is the risk, actually, the standard deviation, and this is the return. Forget the return and look for the lowest return. So the lowest return, the lowest risk actually is coming with portfolio B. And if you draw the line to the return, you will find this return to be P, which is this is the actually the maximum return you can get for this minimum losses. And this is how the portfolio. So you will start by choosing the least return. Now, just give you an example. So this is the, how can you calculate the return? This is how you calculate the return of the portfolio. First, you will calculate, of course, the this one, and then the risk, and then you will match it with its return, and you can calculate the return and the risk for any portfolio. So the minimum risk portfolio, it's a combination of assets that reduces the variance of the portfolio return on the lowest visible level, which is this one. So because it's low risk, then you will have low return. So if you check the following slides, look at this one. If I have a portfolio, just an example, of 2, 1, and 2, the weights of them is 40% and 60%. And the return of the first loan, this is 2 loans in this portfolio, or 2 assets, 10%, 12%. And then this variance, and this is the standard deviation. And this red thing is actually the correlation between the return of 1 and 2. The variance between 1 and 2. So the variance between 1 and 2 is actually here. Now what you do is You go and you calculate first the return. So the return you have just very straightforward. The return have no problem. 40 and 60. This is the weight of the first one times its return, and the second one the weight times its risk, which is 14 times 12%, 6 times 12%. So this is the 11% of the portfolio. So this is actually 11%. Now we are talking about portfolio. Come to the risk. Risk, this is the formula, which is, you can find it here. It's here, this formula. So you have to calculate this, all the variances, and then you have to multiply the variances by itself with the correlation between those variances. And this is what we did here actually. So we take the first weight. This is the second weight. First weight times its variance. Second weight times its variance. Then you have to multiply the first weight, the 2, which is this one, 2 times the 2 weights times the variance of the first one, the correlation times the correlation times the variance of the first one and the second one. It's here. Second variance, this is the variance, and this is the second variance. And this is actually the correlation, and this is the weight. So 2 times weight 1, weight 2, variance 1, variance 2 times the correlation. The correlation times variance 1, variance 2, which is actually this formula. So it's very clear. Now let me go just from here. I think I'm done here. Now we go to the derivatives, which is the how to hedge. We have, this is just some trend showing the credit derivatives are proportion of total derivatives used by Australian banks. This is just for credit risk. We have so many derivatives for so many things. This is for the credit risk, which you can see it's taking up to 60%. And during the financial crisis, credit default swaps is a credit risk derivatives. We have derivatives for exchange rate. We have derivatives for interest rate. This is only for credit risk, which means the defaulting. Now, so we have this type of around 6 type of derivatives to hedge. So we have the credit swaps, credit forwards, which is specified as credit spread on benchmark issued by the borrower. So if I issue a loan or I buy a bond, when the borrower was, for example, have a spread of 5%, then suddenly after a year, the spread is becoming 10%. Then in this case, I have to find somebody else to compensate me with this drop in the grading and the increase in the spread. This is one. The second, this is how the credits forwards work. Future and catastrophic risk, this is just like an insurance. It's catastrophic futures allows property causality insurance to casualty insurance. Insurers to hedge extreme losses that occur after major disaster. So, for example, we have those hurricanes in the United States. Hurricanes specifically in the United States. I know so many cases of them. They just, if your house go, animals, whatever, they will compensate you fully for your house, and then you can go and buy a new house. Now, this is the same thing when for example, the bank issue, give business loans or give housing loans in one area, and this area completely, distracted because of hurricanes. Now the customers cannot pay, but the insurance will pay to the financial institutions. You can talk about this, or you can talk about any casualties happen to the property. With credit swaps call option, this is a payoff. It increases as the default risk premium benchmark bond of a borrower increases above some exercise spread. So this option will be exercised if the spread, if the benchmark, you put a benchmark, if that benchmark increase, which is the exercise price, if the spread increases, then in this case beyond the benchmark, then you have the right to exercise the option and to claim. So you can claim when there is a default risk premium increase over a benchmark on a bond. Now, digital default options, this is pays stated amount in the event of loan default. So it's fixed. It has nothing to do with the, they call it an option, but the option is if there is a default, they will compensate you for a certain amount, like an insurance. Now, catastrophic call option, this is, they hedge a risk of unexpected high losses being incurred by property casualties insurance as a result of catastrophes. This is actually looks like the future. It's the same thing. However, this is an option and this is a future contract. And then we have the credit swaps. Credit swaps actually, and this is the credit default swaps we have during the financial crisis. So the swap involving an obligation to pay interest at a specific fixed or floating rate for payments, representing the total return on a specific amount. So the swap involves this is an obligation to pay interest at a specific fixed amount. I will show you how does it work now. So you have to swap the return. You can use the what we call the bond return, and they will give you the labor. You can spread the labor return against the interest, which is you can swap it against fixed or floating. So you swap, so you give the labor rate, and they will give you the current rate. So pure credits, it's the same thing. However, this one will, this actually clear swapping. This is clear swapping for the premium. So you always give the labor. They will give you the, they will give you the whole return. Here only they will give you the premium. So you hedge actually against the premium. Let me show you an example here. So we will not be responsible about all of this, part of them, but let me give you an example of the total swaps. So if a bank issue 5 million loan to a firm with a credit, A minus credit rating. Now in this case, the treasury bonds, so the loan is 4.5 years. This is the duration. The credit swap between the credit spread. Now the spread when they issue the loan was only 2%. But then later on, the spread actually have dropped to 5%. Now, if you look at the change in the loan, is actually the change on how much the change from 2 to 5, which is 3%. 3 actually percent. Now, this is the change between the 2% to 5%, then this should be actually, if I'm not mistaken, it should be 3%. Let me just call this one. So this is 2%. This is 5%. So if this is the case, this one should be like this one, and this one should be like this one. And this should be 3%. Okay, so in this case, the change in the loan will be this amount, which is the loan times the duration times the change in loan. We have seen this product when we calculated change loan of 1 plus R. So we find this to be, if you continue with it, it will be 675. Now, in the same case, you have to look at this one. The bank hedge its risk with a credit spread forward and receives from the credit spread the difference, which is 5 minus 2, which is 3%, times this, which is 675. So the loss in value of the loan due to drop in credit rating of the borrower is completely offset with the gain from the credit spread forward contracts. This one is also, when you want to look at it, this is what we call the credit default swaps. So you will give, this is the return, floating or fixed. So you and the financial institution will give the labor rate, which is the fixed rate, and they will give you this rate. Whether you just swap it, whether it's higher or lower, so you protect yourself against this return. This is when you have investment. The credit, the pure credits, you will pay a fee, and they will give you a default payments. So you give a loan to a customer, financial institution, lender give a loan to a customer, and in this case, it pays a fee to another financial institution who will show you or will give you a swap. Against this fee, they will swap some types of default payments. Now, this they will swap with an amount when there is a defaulting of the customer default. This is how the pure credit swaps work. Now, as I said, we can manage credit risk using loan sales and securitization, and that will remove the credit risk. It will reduce concentration risk, and this allows financial institutions to spread the credit risk exposure from lending process itself. There'll be a reduction in concentration risk because you can diversify your portfolio, through geography, by selling loans originated in the original center and buying loans from other centers. So we want spread, and we know this in securitization. But you have also to maintain customer relationship. You have to be careful about maintaining the relationship, and also you have to be also careful about the moral hazard issues, which means financial institutions should not give risky loans and sell them and let other people, take the losses out of that one. Also, you have, when you do securitization, you have also to be careful about how many, changing the loan from one buyer to another buyer. And when your customer keeps shifting from one investor to another investor, you may lose the customer. So, and the borrower, and your customer relationship. So you have to be also careful and consider these two issues, which I told you, the maintaining, which is calling for less. This is actually calling for less selling and securitization. This also you have to be careful by being careful of, securitization will help, but you have to give always, you have to maintain quality loans. I think I'm done here. This is just a summary, and I'm done. Thank you very much. I hope this part is easier than the other part. I will just stop here, and I want to thank you very much, and see you in the tutorial next week. Bye-bye.